All right, welcome to Talk Tickers. Today we're diving deep into the third quarter earnings for Acumen Pharmaceuticals. That's ticker ABOS. Let's jump right in.
So here's the big question right off the bat. On paper, Acumen had a really clean quarter. I mean, they executed well, they beat the street's estimates, but the stock? The market's reaction has been, well, pretty lukewarm. It's a real puzzle we're going to unpack today. Why is there such a disconnect between these solid results and what seems to be a very skeptical market?
Okay, first up, Acumen's Q3 snapshot. And really, it was a clean beat. Let's look at the numbers.
So the headline number here is a GAAP loss of 44 cents per share. Now, why is that a good thing? Well, Wall Street was expecting a loss of around 61 cents, so Acumen came in and beat that by a whopping 17 cents per share. That's a pretty significant beat.
Let's zoom out and look at the whole picture here. The earnings per share beat, super clear. Revenue at zero, totally normal. That's exactly what you expect for a biotech company that doesn't have a product on the market yet. Their net loss actually got smaller compared to last year, and they're sitting on a decent pile of cash, about $136 million. So, from a financial standpoint, things look pretty solid. But the real question is, how did they pull off that beat?
And the answer wasn't some surprise revenue stream. Nope. It came from something that investors love to see, especially in this market: good old-fashioned capital discipline.
And this slide just says it all, doesn't it? Look at this. Research and development costs down 19% year over year. That's mainly because they've finished enrolling patients in their big Alzheimer's trial, so those costs naturally come down. And on top of that, general and admin expenses are also down 10%. You just have to call it what it is. This is really disciplined execution.
And because they're being so careful with their spending, management can come out and confidently say this: they have a cash runway that gets them all the way into early 2027. That timeline is absolutely critical, and believe me, we are going to circle back to it.
So the financials look good, but let's be honest, that's just table stakes for a company like this. For Acumen, the real story, the real potential value, is all in the clinical pipeline. Okay, let's talk about their lead drug, Sabirnetug. Now here's their big idea, their core bet. Most Alzheimer's drugs you hear about go after the plaque that builds up in the brain. Acumen's approach is different. They're targeting what they believe is the real culprit, these tiny, toxic, soluble bits called A-beta oligomers, before they clump together into plaque. That scientific difference? That's the entire bull case for this company, right there.
And this timeline, honestly, this slide is everything. This is the whole game right here. You've got two huge events coming up. First, in early 2026, we get some data from their enhanced brain delivery program. But then, the big one, the main event, top-line data from their key Alzheimer's trial, Altitude-AD, drops in late 2026. Now look at the bottom line. Their cash runs out in early 2027. They are cutting it incredibly close. That timeline is razor-thin.
While we wait for that data, they're not just sitting on their hands. They're making some really smart moves. They've got an open-label extension study going, which is great for long-term data. They've partnered with JCR Pharma on some cool new tech, but maybe, just maybe, the biggest move is this last one. They brought in a new chairman, George Golombeski. Now, this guy is a heavy hitter, a veteran dealmaker in the biotech world. And you have to ask yourself, why do you bring in a guy like that? It's a pretty interesting signal to send to the market, right?
Okay, so they've got a clean financial beat, they're making smart strategic moves, which brings us right back to our original question. What is going on with the stock price? Why this huge disconnect?
If you look at the last 3 months, things don't look so bad. Acumen is up about 40%, which is pretty much right in line with the overall biotech index, the XBI. So, it's a solid return, but really it's just been riding the wave of the whole sector.
But this is where the story gets really interesting. Look at just the last month. The biotech rally kept going, with the index up about 10%. But Acumen? It went the other way, dropping a sharp 15%. That is a massive divergence. The market is sending a very clear signal here, and it's not a positive one.
So what you have here are two completely different stories being told at the same time. On one side, you've got the Wall Street analysts. BOA is still saying buy with an $8 price target. If you look at the analyst consensus, they're basically saying this stock could go up hundreds of %. But then you have the other side, the market itself. And the price action is screaming that investors are getting nervous about that long wait for data, the fact that this trial is pretty much all or nothing, and of course, that razor-thin cash runway we talked about.
All right, so let's put all the pieces together. Here's our take on the whole situation.
If you're looking at this stock, you have to approach it in 3 steps. First, you absolutely have to acknowledge the risk. This is a classic high-risk, high-reward biotech play, and late 2026 is a long time to wait for the answer.
Second, you need to factor in the optionality. That early 2026 data on the brain delivery tech is a nice little wild card. And third, you have to keep your eyes glued to that timeline. Their cash runway is just barely enough, meaning any little hiccup, any delay, could mean they have to raise more money, and that could dilute shareholders right before the most important news in the company's history.
So, with all that in mind, our rating on this is market perform. Look, the company is doing a great job on execution, and the science is genuinely fascinating. But the market's hesitation makes sense. The risks from the long timeline and the tight financing situation are very real. We think this stock is probably going to be stuck, just moving with the rest of the biotech sector until we get much, much closer to a real data catalyst.
Now, if you're thinking about how to trade this, here's an idea. The options market is pricing in massive, massive price swings. Implied volatility is over 350%, which is just insane. That makes buying plain vanilla call options incredibly expensive. It's almost a sucker's bet. A potentially smarter way to play for an upside surprise could be using a long-dated call spread that targets that late 2026 data release. What that does is it caps your potential profit, but it also clearly defines your maximum loss and, crucially, it dramatically lowers your cost to get into the trade. It's a way to bet on success without paying an arm and a leg for it.
And that brings us to the final and maybe most important question. What's the wild card here? We think it's the new chairman, the deal maker, George Golombeski. His appointment screams, "We're open for business." So the million-dollar question for investors is, can he pull a rabbit out of his hat and strike a partnership or some other deal that creates value before we have to wait for that all-or-nothing data in 2026? That could be the one thing that changes the entire story for this stock.
And just a quick reminder, this is not financial advice. Please be sure to do your own research before making any investment decisions.